All right, well, former Fed Chair Ben Bernanke standing up against charges that his zero-interest policy rate, which the Fed is still practicing, of course, is killing seniors and all the other savers out there. Here's what he wrote this week. Quote, I was concerned about those seniors as well. But if the goal was for retirees to enjoy substantially higher real returns, then the Fed's raising interest rates prematurely would have been exactly the wrong thing to do. So is Ben right? Or do seniors have a point? Former chairman of the Council of Economic Advisors, Marty Feldstein, has some views on all this, some of which were in his article in today's Wall Street Journal, which everyone should read about interest rates. Marty Feldstein, good to see you. Thank you for coming in. So for seniors and other savers, particularly seniors, though, who don't have a lot of time and don't want to put their money in the stock market, it's very simple. They're losing money, and they blame Ben Bernanke. Are they right?
I don't think so. The way that seniors got hurt in the past was by inflation. When we had higher inflation, we also had higher interest rates, but you paid taxes on those higher interest rates. So when you actually looked at your after-tax return, it was often less than the inflation rate. So people were losing more money back in the bad old days in the late 70s and early 80s. They were losing more money then than they forego now with today's very low inflation and very low interest rates. And by the way, the saving rate recently has been rising. Saving in the last few months is averaging around 5.5% of after-tax income.
Well, and there could be a lot of reasons for that. I think part of it might be that people are a little nervous about the future and they want to put some money aside. But clearly, if inflation, as low as inflation is still above interest rates, and that means that if you're saving money, you're losing money.
But if you move both of them up, if you added 3 percentage points to the interest rate and 3 percentage points to the inflation rate, you'd lose more because the government would come along and tax that interest and make it worse.
But Professor,
So
your
it's a
article
catch-22.
today is clearly pointing the finger at the Fed and saying you guys aren't raising interest rates quickly enough.
That's absolutely right. I think that the Fed is creating two problems with its plans for a very, very slow increase in interest rates. One of those problems is that it could lead to higher inflation over the next few years. The unemployment rate now is down to about what we think of as full employment, around 5.5%. And if you look at the folks who are out for less than 6 months, it's well under 4%. And those are the kind of thresholds that historically have triggered more inflation. But the other thing that worries me, and I think should worry the Fed, is a concern about financial instability. These very low interest rates that we've had are causing all kinds of risk-taking in the stock market and the bond market by bank lenders, which could come home and really be a problem.
Yeah, it's because people can't make money saving on regular interest on fixed income. Therefore, they make risky bets. It also is changing the whole banking structure because the old style where savers would put their money in the savings deposit account, which was nice and safe, then the bank would lend that money out, and the money that it would make on those loans, it would return to savers in interest. That whole system is falling apart because banks aren't lending money out at these low rates.
And what a lot of folks are doing is they're putting their money into exchange-traded funds for bonds. And they say, well, I can sleep well at night because if I need to get out, I can get out on a day's notice. The real problem is that the ETFs, the exchange-traded funds that are holding larger and larger amounts of corporate bonds, they're going to have to sell those bonds in order to pay off the individual investors. When they go to sell those bonds, they're going to drive down the interest rate, drive up the interest rate, drive down the price of those bonds. So I think that's a very fragile part of our financial market.
I have to get this final point in because it's something that the Fed is insisting on, reaching a 2%, boosting up inflation to that 2% level that they want. Why is the Fed so fixated on increasing inflation, taking money away from us?
Beats me. Where did the 2% come from? It's just an arbitrary number that started being set by central banks around the world. And if you take out the special temporary effects of lower oil prices, our core inflation rate's about 1.5%. Big deal to go from 1.5 to 2. Who cares?
Yeah.
Seems to me that the Fed should really worry about doing anything that would get us back into the kinds of almost double-digit inflation that we used to have.
I think everybody doesn't want their prices to go up. Marty Feldstein, good to see you. Thank you, sir. Appreciate you coming in.
Good to be with you.